G'day and welcome to the Motley Fool's regular weekly series we call What I've Been Reading, which is not particularly imaginative, but at least it is pretty descriptive, because every week I sit down with one of the Motley Fool analysts and talk about what they have been reading, what's on their proverbial nightstand. Why do we do it? Well, a couple of reasons. Hopefully we help you learn a little bit more, but also because the guys are just curious and interesting people and they want to read and they want to share. And so that's exactly what we are doing. I want to say the guys, in this case, one particular guy, Ed Vesely. Ed, g'day.
Hello, Scott. How are you?
Mate, I'm very well. I hope you are too. What I love about the stuff you bring, mate, most of our team bring books, which is fantastic. You read very widely, including research and academic papers. So you've bought us one particular paper. It's called The Alchemy of Multibagger Stocks, an empirical investigation of factors that drive outperformance in the stock market by Anna Yartseva. That's a pretty good title, mate. I will ask you about what's the article tells us, and I'm sure you'll do it anyway, but I will ask you directly first. What is a multi-bagger stock?
Oh, yeah, good place to start. Before we even go there, I don't read these academic articles in large numbers or anything like that, so don't get that idea. I'm not that boring, I hope. But I came across this. But to answer your question, a multi-bagger stock is basically a stock that rises in value by, 2 or 3 times or 4 times. So if we say it's a multi-bag, say if something multi-bags 10 times, that basically means it's gone up in value from $1 to $10. Effectively, a 100-bagger is therefore $1 to $100.
Nice. So multi-bagger is multiple times of its initial value, right?
Yes, absolutely. And we'd love to have as many of these as possible.
Yes.
Of course. Why wouldn't we?
Yep.
So that's a multi-bag. Okay, so coming to the article. So Anna Yartseva, she's the senior lecturer in economics at the Birmingham City University. She's obviously been researching this topic for a little bit of time through 2024, and in February 25 this year, she published this article. And I thought, oh, that's actually a very good title, because I thought, well, why wouldn't you want to know what drives outperformance in the stock market, right?
Yep.
And she has areas of expertise in macroeconomics, economic policy, and the property market. So maybe she's also developing some research expertise in the stock market as well. But I guess the reason why this article came about was because, according to Yartseva, there was in her opinion, and she's probably right, there has been a shortage of academic literature in this area. So we do know that there's a lot of people practicing investing, and they talk about it and write about it and even publish books on it, multi-bagging stocks and so on. There's actually not much academic rigor out there. So this actually was just trying to address that little gap in the knowledge market, I guess. The other part of this research is that it's actually very recent. So one of the drawbacks of much of the older research is that it's relied on older data. So this actually modernizes the data a bit more. So hopefully we can rely on it. And the study focuses on exactly 464 company shares where they've multi-bagged. On American exchanges, so I'm presuming that's just the NASDAQ and the New York Stock Exchange, and they've risen in value by at least 10 times between 2009 and 2024. So that's basically the premise of what the research is about. And I guess, look, you know about Warren Buffett, we all do. We all know about Benjamin Graham and David Dodd. They published security analysis back in 1934. There's also been a number of people that have written about how do you get these multi-bagger stocks. Thomas Phelps was another guy who wrote 100 to 1 in the stock market in the early 70s. Peter Lynch we know about, One Up on Wall Street. There's also an Indian gentleman, and I spoke to you last week about that fact. I'll release that in a moment. But Motilal Oswal, he publishes the annual wealth creation studies, and so he's an Indian. He studies the Indian market. He practices and manages money in the Indian market. And this is a funny thing, Scott. He found that the Indian stock market itself had actually 100 bagged between 1979 and 2006.
That's extraordinary, isn't it?
So that's a market. And I guess the reasons why that came about, I'll go into those now. We're talking about stocks, but it was just very interesting that the Indian market would perform like that. Now, that's according to Oswald himself. Look, part of it is that there's a long runway for growth. Prices were probably pretty cheap in the first place. So there's plenty of opportunity for those people to have held maybe an index fund, if there was one back then in the 70s, to actually benefit from that. But look, the whole book does rely on the premises of people that have come before this article, and I do also mention to Chris Mayer. He's a very good author who's written 100 Baggers. Now, all of these people, though, are not academics, and I guess that's, as I say, that's where this article is trying to just trying to find technical evidence for what actually creates a multi-bagger stock. Now, what we do know is that when we're looking at stocks, okay, we should actually, this is what we do know and what we think we do know. The size of a company does matter. So typically, if you're going to be buying shares in Telstra today, you're probably not going to get a multi-bagger, at least not in your lifetime. So maybe looking at a smaller company is the way to go. I think the quality of a company is very important as well. Returns on equity, returns on invested capital, etc. Anytime you're going to get high returns on the capital invested in that business and the debt as well. So that's actually also important, and is perhaps an indicator that we've got a quality business here. And of course, you need growth. Now, you can't have growth by itself. Yartseva challenges if you're just looking at, for example, earnings per share growth, that's not actually going to provide any significant materiality towards predicting future multi-bagger returns. But if you combine growth with high quality and size, a long growth pathway, and also, very importantly, a very low multiple to begin with, then you have the ingredients for a multi-bagger. So that's what we know. Now, what this author has done is that she's come out and said, okay, this is what we found. These are the starting points for the future. And so what her contribution is that there's a number of points here where we can add to these points, the previous factors that I've mentioned, and perhaps these will lead to multi-baggers. Nothing's guaranteed, of course, but evidence does show that these are a good place to start when you're looking at stocks and you're looking for hopefully some very high returns in the future. So, high free cash flow yield. Now, high free cash flow is generally considered, I think, better than, say, an earnings yield. So, for example, if a company was earning $5 per share and the company is worth $100, I'm just talking about the share price, of course, then you're looking at a 5% earnings yield. But Yartseva says, well, maybe you should look at the high free cash flow yield instead, because an earnings yield is probably not as reliable, mainly because it doesn't truly show the cash generating ability of the company in its operations. So, for example, you can look at the earnings, the income statement. Sometimes there's accounting manipulation, there's non-cash charges against the income statement. Just looking at free cash flow basically just says, okay, this is the money that this company is generating. What do we do with it? Do we put more money into, R&D, for example, or do we pay more dividends? Do we pay down debt, etc.? So, high free cash flow yield is very important. Personally, I like to look. I like to look for both, dividend stocks and growth stocks. I'm just looking for value wherever I go. I suppose my minimum threshold would be a 3% yield. But if you can get more than that, 5 or 6 or 7%, and other factors as well, you're potentially looking at something that could be a good candidate for a portfolio. So high free cash flow yield. The other thing, Scott, there is evidence that there is aggressive investment linked to operating earnings growth. So when I say operating earnings, I'm talking about EBITDA, so earnings before interest, tax, depreciation, and amortization. There is aggressive investment linked to that growth. So I can use, for example, there's a few examples here in Australia. Cochlear is a good company that does a lot of that. Ansell, the glove maker and protective gear maker, and also Aristocrat Leisure. Just three companies that have actually do demonstrate lots of R&D and reinvestment in the business and its core products, but also significant share price growth over the long term. So I'm not talking about the last 3 or 5 years necessarily. We've had COVID and we've had lots of other interruptions on the market, higher interest rates and so on. But if you look over the very long term, that is an indicator. The other thing too, which I thought was interesting and is really out of our control, is just a stable interest rate environment. Now, when I read that, I say, okay, rising interest rates aren't great because of the effect that it has on share price performance. Perhaps too, though, falling interest rates are not good as well, because it just potentially, not always, but could lead to higher prices, making the investment equation that much more difficult. So that's one factor. So we're going to invest anyway, Scott, for the long run. We're going to invest through the interest rate cycle. Interest rates will go up, they'll go down. We are genuinely interested in maintaining our share ownership for many, many decades, hopefully. But there will be times when stock prices will come close to their 12-month lows, and if they are cheap, or cheaper than where they've been in the past, then potentially that's another indicator that you can look at to say, okay, I think I potentially have a good investment idea here. No guarantees it will necessarily multi-bag in 5 years, but it could happen in 10 or 15 years. So that's basically it. Now, academic research has determined this. To me, it makes a lot of sense, intuitive sense. It's, I wouldn't say it's obvious, but I think when we're looking at stocks for our scorecards here at the Motley Fool, Scott, I think we do find that, yes, we are looking for value, aren't we? We're looking for growth. We're looking for earnings yield, free cash flow yield. I do like to see, not necessarily aggressive research and development, but I do like to see a good amount of it. And yeah, obviously a cheaper price. So anyway, look, that's basically the bottom line. The story is of this article, it is fairly long. It is a little bit dry in places. It is, after all, an academic paper, so it's not the most enthralling read in parts. There's a few formulas and so on in there, but they're the conclusions. And I think when we're looking at stocks, that's us, but anyone watching this video and looking to buy for their own portfolio, these are the key factors. And so I think if anyone wants to go further with these ideas that I'm talking about, certainly look up the article online and have a read. Just give yourself half a day to read it, just to really study it. Not so much to rush through it, but really just, reread a couple of the key points, highlight things and take your time to go through it. And I think you'd get a lot of value out of reading a paper like this. And certainly too, go back to Peter Lynch and Chris Mayer, read those books, because they're very, very good. And this paper then sort of gives you another level of information that you can then process and consider for your own stock picking. And as well as that, go to the Motley Fool, buy our services, because we do all of this. We're not going to always find every stock is going to be a recommended winner, but we are, on the whole, we're doing okay with the scorecard. And I think that's because we practice this process of looking for value, looking for high returns on capital, and investing for the long run. I think it's also very important that if we're going to be investing for the long run, that we do believe that there is a long run future for the company as well. That's an obvious point.
Very nicely summarised, mate. Saves people reading the article, but I reckon it's actually worth doing. And we will put a link just below this video here to that article. It's freely available on the internet, so we'll drop a link down there. Ed, thanks for sharing the alchemy of multi-bagger stocks with us. I'm sure our viewers will enjoy getting their teeth into it themselves, or maybe you've heard enough just from Ed running through it. As he says, makes obvious sense, but it's always nice to have that backed with a bit of academic rigour as well. Well, thanks for watching. If you are here, by the way, and you're enjoying these videos, do us a favour, hit the like button, because it's good for us and good for our egos, but also hit the notification and subscription buttons. Why? Because we've got lots more great stuff coming out. We've got Stock of the Month, Stocks in Focus, Motley Fool TV coming up soon if you're watching this roughly in real time. It's next Wednesday or Thursday, so make sure you tune in for that. And the best way to know when they're coming is to hit that notification button once you've subscribed to the channel, and then YouTube will send you an alert when we've got good stuff coming up or coming out. You don't want to miss either of those. All right, that's it from us. Ed, thank you for sharing your expertise. Fools, thanks for watching. Until next time, Fool on.
Okay.
Beautiful. Thank you, buddy.